Hello, everyone, and welcome to our webinar of this month. And we are going to be talking about RMDs, Roth conversions, and different aspects of your retirement. This presentation has been updated with all the latest changes in the law and the tax law. So, well, you will see some different things here. Please, if you have any questions, I will suggest to leave it. If you want to just write it in our chat, we will be reviewing that chat. So we will be taking your questions into consideration. And well, feel free to just ask whatever comes into your mind about what we are going to share today. Our first slide is always this disclaimer. Remember, I'm not acting here as your financial advisor. All the information that we are going to share is for educational purpose only. If we are showing some returns, remember, we are not trying to sell you an investment product or things like that. So, after you see all these letters, all those disclaimers, I think we can start with. So I think the first step will be introduce myself. As you know, I am a certified financial planner. I have been in the business for the last 27 years. Well, I have been named by Investopedia and by ETF between the top 100 financial advisors in the US, and recently by GoBank Rates named me between the top money experts. This is something that makes us really proud, because in that ranking, I mean, I'm sharing that ranking with Warren Buffett, with Mark Cuban, with Susie Orman, with Dave Ramsey, and many others. So I would love to jump. One of my main goals is to share information with you so you can take an informed decision about your finances. So RMDs. So have you ever imagined, like, maybe when you're 80 years old, you're gonna be maybe paying even more in taxes than in your best professional years? This seems like really hard just to imagine that you're gonna be paying that such a big tax bill when you're over 80 years old. So that's why in this webinar, we are just going to discuss about the basics, like what are RMDs, how do you calculate the RMDs, what are you have to take into consideration, and different aspects about this. This is not a presentation for financial advisors, so I'm going to try to make it really easy for you. Please ask whatever questions that you might have. So at the beginning, this is the agenda for today. We are, as you have said, we are going to talk about RMD basics and what you should know. There have been some changes with the Secure Act 2.0 that moved the ages when you have to start taking those RMDs. As I said, you saw that comment that I made. It was like, if you don't do anything, those RMDs are going to keep, increasing in time. So you don't want to have like this huge tax bill when you are at that age. So let's talk also about some Roth conversions, some changes with the new laws, and whatever questions you might have. So RMD basics and what you should know. As you know, until now, most of the people that are hearing this webinar, maybe they are over 65, 70, or even more, or they're already taking some RMDs. So most of the people, they didn't have the chance to be saving in a Roth 401k or Roth IRA, because maybe when you're already retired, those options were not the ones that people were using the most. So maybe most of your money is in a traditional 401k or a traditional IRA, because, well, you have been contributing to these accounts, and Uncle Sam has been giving you the opportunity that all that money that you have been contributing for all these years, you have been able to reduce your taxes with deductions for those years, and that money has been able to grow tax deferred. So it means like, yeah, it's tax deferred, but now Uncle Sam needs his money and wants his money. He has to be, for all these years, your retirement partner. But now he says, I need to get out of here. I need to get my money. Because he knows that each time you withdraw some money from those accounts, not that money is coming like income to you. Those withdrawals are income to you. So RMDs are just mandatory. You don't have the option. the IRS is going to tell you how much money you have to withdraw from those accounts. And all that money is going to come as income. What kind of accounts are we talking about? Well, your traditional 401k, your traditional IRA, your 403b, your simple IRA, your SEP IRA, your 457, all these accounts that have been growing for all these years, tax deferred. Which ones are not the ones that are under the RMD rules or that have to take those require minimum distributions? Those will be the Roth 401ks and the Roth IRAs, because you already pay taxes on that money. And if you, if you go for all these years saving in those accounts and you're over 59 and a half and have that account for more than 5 years, you're going to be able to withdraw all your money tax-free. So now we know what are those RMDs and what is so important for you to know, because it's something that is going to happen. It's something that you're not going to have the option to decide if you want to take it or not. So now that you have this first idea here, we will say, okay, when should I start taking my required minimum distributions? The rule before was like you have to start those RMDs when you were 70.5. Which was really difficult for many people. I mean, like to understand why it was 70.5 years old. And the reason is like the IRS and that on those ages thought like it would be a way for be more fair for people that was born in 1 year and people that were born in the next year. So they decided like, let's be in the middle. But people said that was kind of complicated, and then they came on this new law in the Secure Act 1.0. It was in 2019, and those, that were born between 1949 and 1950 had to start taking their RMDs when they were 72. So we can say that someone that is was born in 1950, he will be already 75 years old or 70. So he's already taken those RMDs and also the ones that are before that. But now it came the Secure Act 2.0 in 2022. Now I moved that age to 73. So if you were born in between January 1951 and December 1959, well, your age will be 73. So maybe if you were born in 1951, you already are taking your RMDs. In 1959, you still have some change. You have some time because you're maybe 66 years old or something like that. So you're not 73, but that means that people that were born until that year, that this is going to be their RMD age, those 73. And for those that are born after 1960 or later, of course, they'll have to start taking those RMDs after when they reach 75 years old. So as you can see, it's kind of complicated, but once you learn what is your RMD age, it's not going to be changing anymore. This is what we think for now. So now I know, okay, I am 73 years this year, or when should I have to start withdrawing that money? Well, you can start withdrawing that money this same year, in 2025, or also just for the first RMD, you can wait until April of the next year in 2026, for example. But then from then on, all the RMDs have to be taken before the last day of that year. Let's make an example here. So you can start this year, 2025, and then next year, you will take the RMD for the next year. There are some people that maybe want to wait and they want to say, I'm not going to take it this year. Maybe I'm going to wait for next year. And next year, I have till April to take that RMD. And then before December, I have to take the second RMD. The only thing with that we have seen, it doesn't work sometimes, because as remember, you're receiving like 2 paychecks, big paychecks for that particular year. In the next year, you're going to be receiving the RMD from the first year and the RMD from the second year. By the way, remember, this only applies for the first RMDs. All of these next ones have to be taken before December of that year. So why somebody would want to take the RMDs in the next year? Well, maybe you're a consultant and you just received this year, I don't know, You made a great job this year and you just received from a client a really good payment this year. And you say, you know, for next year, I'm retiring. I'm not going to receive any more money because of my consulting business is over. So maybe you can move it there. If not, in most of the cases, delaying that RMD could make no sense at all. Sometimes people ask us, is there any way to stop these RMDs or to postpone those RMDs here? I would say the only way will be if you're still working and you're not the owner of that company, you don't have more than 5% of that company, and you have the option to be sponsored by that 401k, and you have the option to participate in that 401k, well, you don't have to take RMDs from that 401k. But if you have this 401k and also you had an IRA, you have to start RMDs from the other account. So this is the only case where you can postpone in a way of those RMDs because you're going to be still working and participating in that 401k. Okay, so now we know what are RMDs, what year you have to take it, and when you have to particular do that withdrawal of that amount. This is something really important. It's a withdrawal of that amount. It's not like, oh, I'm going to move that money, I'm not going to receive it, and I'm going to move that money to a Roth IRA so it can keep growing there. No, you have to withdraw the money in this case. So even though if you don't need it, some of our clients said like, but I don't need the money. No, you have to take it anyway. Then you can do different strategies. You can invest it in a regular investment account or do something with that money. But yes, you have to withdraw the money there. So how much should I withdraw? So there is a formula that sometimes people don't know. Sometimes people can use one of those online calculators that can help you, or maybe your custodial, if you have your account with one of these big firms, big financial firms, they will tell you how much you have to withdraw. But it's important for you to know where this number comes from. And the way this is calculated is something like this. The IRS have what they call like different tables. And in those different tables, you're going to find what is part of this equation. It's going to be what is called the life expectancy factor. In this way, this is going to be the denominator of this formula. But the numerator, the number that goes here, is going to be the balance of your retirement deferred account by December of the last year. So if I'm calculating this number, I will take the balance of my 401k, traditional 401k from the December 2024. And then I will look what is my life expectancy factor. This is one of the tables that most of the people will use. I mean, and the way to use it, it will be, well, you're 73. So your life expectancy factor, as we can see here, will be 26.5. Let's see an example about that. So if you want to check an example and say like, well, you have been saving a lot and you have been able to manage a large nest egg here. And just for example, let's think that you have $3 million by December of 31 of 2024, and you're 73. And as we saw it, you go to this table, you look for your, life expectancy factor, and now you're just going to divide those numbers. And this is going to be your RMDs, those 113 in my example. So now the way for you to know how this table works, as you can see, each time the years goes by, the denominator, this number that goes here, it gets smaller and smaller and smaller. People say that with this AI, it's like with the technology and everything that is going on, people are going to start living longer and longer. We're just running an example. You can see it here. Like if you go over 100 years old, the denominator gets really small. It's like 4 or something like that. So if we follow that same example, and now you're in that, for example, I'm taking this 6.4, you reach 100 years old, and you still have $3 million because that money has been growing, the stock market has been doing really well. Now, look how your R&D is changing. And remember, all this money is coming as income to you. So this changed a lot the situation because now maybe you're making more money than the money that you were making when you were working. So be careful with this. It's really important to know how much you have to withdraw. You cannot change it. That's the law. It is what it is. Okay. So if we're here, some people ask me, and what about if I forget about taking those RMDs? I mean, is there any penalty? Yeah, the penalty has been reduced. It was before, I mean, before it was 50% of the money that you should be withdrawing. In this case, for example, it was 113. Half of that will be your penalty. But now the penalty is reduced to 25. Is this still a lot of money? But it could be reduced to 10% if you correct it. You say, oh, it was my mistake. In the first 2 years, you say, oh, I was mistaken here, and you're gonna take those RMDs, and then you will have to pay that penalty in any ways there. But it's way less than that 25%. So yes, there is a chance for you to, I mean, reduce those penalty, but you are here in this webinar is particularly for not to be making those mistakes there. So be really careful with that. You don't want to have that. So I'm having here a question. It says, if a spouse inherits a Roth IRA, if any RMDs kick in, what about a child who inherits? Let me just, I'm going to try to divide this question here. So if it's a spouse that is receiving the IRA, if it's a Roth IRA, you don't have to take any RMDs because it's just a Roth IRA. So you just receive your RMD, your Roth IRA. You don't have to take those RMDs here. And you're the spouse. You're not. I mean, if it's someone different from the spouse, there is a 10-year window that you have to withdraw that money. The money can keep. I mean, if it's not a Roth, it's just a regular account. If it is if it is a Roth IRA, the money can keep growing tax deferred for 10 years. After 10 years, you have to withdraw the money from the account. There are no taxes, but you cannot leave the money there in that account. Okay. What about a child who inherits? That's the difference. I mean, that's the difference. I mean, like the child will have those 10 years. The spouse is a completely different treatment. If it is a child, he will have 10 years for that money. That money is growing tax-free for him. But the difference will be if he inherited a regular traditional IRA, he will have 10 years to withdraw the money, but he would like to withdraw money all the years, because if not, at the end of those 10 years, as it is a traditional IRA, he will have a huge tax bill with that. In this case, if it's a child and if inheriting the IRA, he will have that 10-year window period, and he will not have to withdraw all the years. He can wait until the 10-year, but before the 10-year has to withdraw all the money from them. So he will still have 10 years of money growing there, which is going to be fantastic for his finances there. So if we can review in here, so we were saying like most of the people were here, like they were working and this is their effective tax rate. They were working, so they were producing some income. Now they decided to retire and their tax brackets are going to be really low for many, many years. Then they get to their 73, RMDs start to kick in, and you can see that their taxes are coming way back here. And even it could be really high. You can see that this number can be really even higher than in your best professional years. What we can see here is this valley, and we can optimize this valley. This is what we call this like a valley of optimization. Why? Because your taxes in all these years are going to be way lower. So we can play to optimize those tax brackets. I mean, to start withdrawing some money from those accounts, from those tax deferred accounts. So yeah, you will be willingly paying more taxes, but you can play with the different tax brackets for you not to be over certain tax bracket that you don't want to be because maybe it's too high. So in that way, when you have to start withdrawing those RMDs in the future, you will not have to withdraw such a big amount there. Okay. So the situation will be something like this. This is like a plan to diffuse this bomb. And the way will be, instead of you having all these years working, then years that you're not going to be paying like no taxes at all, but then years that you're going to be paying way too much in taxes. One of the strategies that you can implement is try to flatten that that mountain then there. So your taxes are not going to be as high. And the only way to do that will be optimizing this value of optimization there that we were discussing. And it will look something like that. These lines are going to be your tax bracket. This is the software that we use to run different scenarios for that. And the way to do it, it will be, well, what are the taxes that you want to have to pay here so you will not have to pay that much in the future? And let's keep optimizing this. And there are some people that maybe in the future, they feel that taxes could be higher. And they could be higher for many, many reasons. The first one, maybe you're married and one of you pass away in the future. The other one will be filing single, maybe for many years. So maybe he will have to pay more taxes, even though if taxes stay the same. In the future, maybe he will be having to pay more taxes. And maybe it will be better for both of you now that you're both of you living and married, and you have a bigger standard deduction and things like that. Well, you can keep using this value to keep optimizing those taxes. And what this means is like taking money from that traditional IRA or traditional 401k and moving on, transferring that money or assets to a Roth IRA. That's what you're doing. And when you do that, you're withdrawing money. And because you withdraw that money, you're going to have to pay income taxes on that money, but you are going to play with those income tax brackets. So the new law is bringing a lot of good things because for a few years, you're going to be able to keep optimizing your taxes. One of the new deductions, there is a new deductions for those that are over 65 years old and make less than $150,000 and you file as a couple. Each one of you is going to be able to deduct $6,000 in addition. So you have your standard deduction, and now you're going to be able to deduct this extra $6,000 per each one of you. So what is this doing? It's like you have more deductions, so your taxes are being reduced. And now you have the opportunity to keep optimizing with more Roth conversions, so you don't leave that much money in those tax-deferred accounts, and then your RMDs doesn't have to be as high as maybe they will be in the future. So if you see it in another way, also the standard deduction at the beginning of the year before this change in the One Big Beautiful Bill Act was like $30,000 for a couple filing jointly. And now it has been increased to $31,500. And as if you're over 65 and also married, each one of you are going to be able to add to that number 1,600. So it takes this number, the final number, the 31 plus this 3,200. It will be like 34,700 here. So as you can see, the bigger the deduction, the bigger the opportunity to go for those Roth conversions. And also, if you live in one of those states like California, like New York, where, well, where the state taxes are really high and maybe you have a big mortgage, you're going to be able to itemize those numbers. And if that number is bigger than this $34,000, you're going to be able to use it. Just for example, if you're making less than 500,000, $500,000, and you live in California, for example, and your state taxes are over and property taxes are over $10,000, you're going to be able to deduct up to $40,000. So again, taxes, I mean, deductions are bigger because you can itemize those deductions. So it means your taxes are lower, and in that way, you can go for bigger Roth conversions for those years. As you can see, there is like an art here. There is a balance here that you have to take into consideration because you don't want to go over those 500,000, or if we go back to this deduction of $6,000, you don't want to go over 150. So really, really careful with that. So another strategy, maybe you're already taking those RMDs and you will say, oh, these are great strategies, but maybe for someone that is not taking RMDs already. If your case is like you are already taking RMDs and maybe you don't need that money and you would like maybe to go for some Roth conversions. We said like the money that you have to withdraw as RMD, the IRS needs his money, you have to really withdraw it. But there is one word that it says This is the minimum distribution. You can take way more than that if you want. Just for example, let's go for here in this table. Maybe you're in this 12% tax bracket and you're, I don't know, your RMDs take you to $50,000 per year. But you can take up to 96. I mean, to reach to this 96, you still have like room for $46,000 to keep withdrawing money. So maybe you decide to withdraw, I don't know, like 20 more thousand, and that money can go into a Roth conversion. And a Roth conversion is a great way to leave money to your beneficiaries that's free. Because the way that you should be withdrawing your money, if you have a taxable account, a tax deferred account, and a Roth account, will always go for your brokerage account first. Then go to that tax deferred account and try to leave that Roth IRA account for your beneficiaries in the future. So we have been talking about many things here, but maybe you need us to review your particular case. As I said, we are just touching different concepts here in this presentation, but if you want, you can schedule a free consultation with us where we can review your particular case. Thank you so much